We are talking about 10 shares and ETFs. We've got mostly shares today because we talk a lot about ETFs, let's be honest. So let's talk a little bit about shares. But first, a bit of pop trivia because I wasn't going to talk about this company. It's an Australian company. I'm going to give you a tip. All right. You guys have to guess something. I'm going to share my screen real quick. You guys have to guess something. And if you get it right, I don't know how we're going to do this, but if you get it right, I will send you a piece of RAS merch, but only one person because we don't have that much. This is the thing you have to guess. You see this slide here? There's a chart that I've taken from the Perla website. Just there, that's actually a share price chart. Now, if you can guess which company that is, you get a piece of RAS merch for free. It's it's a 1 year chart. So let me just try and make it a little bit easier for you. This is just in Canva here. I'll get rid of that. I'll get rid of this. I'll get rid of that, this, and this. All right. So this is the chart over 1 year. All right. This is $1.50, just to give you some reference. Whoever gets it right wins. It's not IVV. It's not. Oh, okay. We have a winner already. Geez, that's very, very quick. Mukesh, you got it right. You got it right. That is JDO. Wow, so how did you get that? Have you got like Claude stuck in your brain or something like Neuralink? This is Judo Bank's share price. And let me just bring that up for you. This is it right here, Judo Bank. For those of you that don't know, Judo Bank is a business bank. It was actually established by two people from NAB. Would you believe it? They weren't happy with NAB. So they went and started their own bank. And here it is. So Judo Bank actually did something remarkable. Now, real quick, before we get into like me doing a wonderful disclaimer, one thing that Perla does that no other broker does is when it shows you share price charts and stuff, it actually is designed to make you feel calmer. Would you believe it? Not more like antsy or more like agitated. Where most brokerages would want you to do something, so they try and make it impulsive for you. Whereas this, it actually uses wavy lines and stuff. And I was like, come on, guys, give us the real deal. So I'll go into the Google Finance overlords. This is actually what it looks like. So this is what Google is saying this should look like. This is what Perla makes it look like. Same share price chart. One makes you feel a lot different than the other. And I think that's just a really good indication of how the tools that you use should help you invest for the long term. But anyway, I'm going to come back to that in a sec. Yeah. So Mukesh, you said 3 of their SME loans went down. So I'm going to dive into that because that's actually a company that I want us to put on our watch list. And I'll explain why in a little bit, but that's Judo Bank. So most of us, I'll explain the business in a minute. I won't get into it just yet because it's actually a really cool thing. So just a quick little quote here from Kathy Wood, the famous investor, who was once quoted as saying this RASC, general financial advice disclaimer, which is that the information in this presentation is strictly general in nature. I do not know your needs, goals, or objectives. So don't like act on this. Don't be like, oh my goodness, look at Judo Bank. I'm going to go sell that share that I own now. Like actually stop, think, make sure any of the information you digest and you kind of relate it to your own circumstances before you act on it. We have an AFSL at RASC. There's the number right there. Don't try and call that like it's not a 1-300 number. It's something that you look up in ASIC. And if we do mention ETFs, which we are going to talk about today, just remember they have a PDS and TMD. This is me before the budget, and now I have no hair. So that's all you need to know about me. But seriously, like I've been an investor for a while. I love doing this stuff, and I think for the most part, like most of you would know that we got the podcast, we do courses, we do all that sort of stuff. We invest and do all that sort of stuff, and financial advice for people nowadays. Which I was just sharing my miseries with Zwei and Riss off air about how wonderful it is to have a financial advice business. So keep that in mind. If you're ever inclined to be like, I want to start a financial advice business, give us a call first. So today's agenda, we're going to talk about 3 lessons from the past 12 months, 10 stocks and ETFs for the next 12 months. Now we're going to have to kind of breeze through these. When I say for like the next 12 months, obviously you know that it's like, I don't know what's going to happen in the next 12 months. No one does, but hopefully these things can go on your watch list. because maybe they play out in the next 12 months, or maybe they're interesting for reasons that are not like good reasons, but just something to watch. In the next session, which will be in a few weeks, we're going to do another session called How I'd Invest My Tax Return. Now, most of us, well, not most of us, but some of us will get a tax return. If you do, what can you do to it? I think we'll do with it. The most important thing when you get a tax return or any type of windfall is give the money purpose. Don't let it go into the quote unquote consolidated revenue account in your family budget. Give money a purpose. And if you do that continuously throughout your life, you'll get way further ahead. Now, I wanted to actually flag something here. I'm going to put in a link, pearler.com/lp/rask. So I'm going to put this link in the chat right here. And I'm going to pop it in for everyone, send to everyone. There we go. Just let me know if you can see that. It's in the chat right now. It's just the pearler.com/lp/rask. Now, Rask, we don't make anything from giving you this, but this actually entitles you to some sweet stuff. If you haven't used Pearler before, you can use this and you get one free trade for 12 months. So like over the next 12 months, you get, I think it's one a month. T's and C's are on the website and all that sort of stuff. But if you haven't used Pearler before, you may as well do that because free trades. Who doesn't like that? And if you're an existing customer of Pearler, I have it on good authority that if you say, for example, use the Aussie shares side of the platform, like let's say you're buying Judo, which is an Australian share, but you then want to go and buy, I don't know, what's a company like Apple. You want to go and buy Apple. Well, there's a US share trading account that's like within the same platform. You just need to activate it. You can get a sweet deal on that too. From tomorrow, this will apply. So from tomorrow for existing customers, if you're a new customer, use the link, sign up, cost nothing, get it going. Raj says, love Pearler. Amen to that. Thank you, Raj. Thanks for the endorsement. I'm sure the team appreciate it. But yeah, it's great. Long-term investing, make it work for you. So now let's get back to the slides. I'll come back to this in a minute. So 3 lessons from the last 12 months. I think if we zoom out and we were to look at, say, I'll get rid of that one before it confuses me. We were to look at, say, I don't know, VAS, which is the biggest ETF in Australia and kind of indicative of the Australian market, right? If we look at VAS over the last 12 months, it really doesn't look like it's great. Like there's not dividends in this. There's probably a modest return, 2.6% over the past 12 months, not including dividends. It doesn't look great. And you see some big like drops and stuff down here and here. I can't even remember what that one was, but this one was probably like when the US and Iran got into their war and oil prices went through the roof and everyone was scared. This is probably something to do with AI or something, let's be honest. Who knows? Who can remember, right? And that's kind of my point. There's been so many things that have kind of struck us over the past 12 months. There's been conflict in the Ukraine, which has been going on for a while. There's been rising oil prices, conflict in the Middle East. There's been, as we covered in last month's live webinar, substantial changes or proposed changes to tax policy in Australia, which basically seek to take more tax money from people that invest or business owners. Even with the latest changes or kind of like tweaks, they're still very punitive, very negative for investors. So there's been a lot of change over the past little while. Cost of living's on the rise. Tax rates haven't been indexed, so meaning that even if you earn more this year, you're paying more tax as a result of them not changing the tax rates. And so there's a lot of like things going against us, our mortgage rates on our home loans. But one thing that I've learned over the years is that there's only a few things that you can control in investing. Barefoot Investor, Scott Pape, many of you will know, in his book, The Barefoot Investor, which I've got just down here actually, I've got a few copies. A lot of the kind of good juju that comes from that book is in the form of like knowing what you can control and knowing what you can't control. And one of the big ones was fees. So knowing what fees you have and what fees you don't have. One thing he didn't say in that book was tax policy. You can't control what the government's going to do with taxes and all that sort of stuff. You can't control whether your ETF's going to go up today and down tomorrow. You just can't control that. all of the things that you can control are pretty limited. Like you've got like how much you invest, how often, what things you pick to invest in, when you decide to sell, these types of things. How much you earn is somewhat in your control. It's not completely. That's more a thing you can influence. And I think the more time you spend as an investor, the more time you realize that a chart like this, and I'll zoom in a bit, becomes really, really important for you. Because what it actually reminds us is there's stuff that we just will never be able to control. And the longer you're in the share market, the more that you realize this. There's stuff that you can't control. What happens in the Middle East? What happens with interest rates? What happens with inflation? What happens with tax? That's all on the outside. You can't do anything about that. Things you can influence is when you buy, how often you buy, how you think about investing, the types of strategies you might think are worthwhile and explore. Things you control is like actually doing the things. So, actually setting up an account, choosing to join Pearl today instead of one of those other ones that want to make you act and react. Doing these types of things. These are the things that we should be spending most of our time on as investors, or at least automating. Like we always say on the podcast, that you want to automate the things that move you towards your goals and add friction to the things that move you away. And over the last year, this has been really evident. Most people have realized there's a lot of things they can't control. They can't control how much they're taxed. People who bought property or want to buy property realize they can't really do that anymore. They have no control over that because it's not really worthwhile for them. But they can control where they put their savings, which bank account, which investments they do go and make from this point on. And I just wanted to really highlight that. The second thing I wanted to highlight is if you looked at this chart over time, like over the last year, it doesn't look great. If you could zoom out, however, it starts to look really good. And this does not include dividends. If you included dividends, you'd be a lot better off, a lot better off. And this reminds me of like why we invest the way we do. There was this great study that was done. It was originally published, I think it was 2014 when I first read this. I think that's when it first came out, and it's continued on since then. But there was this article and this whole part of the Schwab website. Schwab is a big US like financial services company, and you can see here they've got this article called "Does Market Timing Work?" And what they did is they ran a scenario of five different investors, one that's got perfect timing, one that's just going to buy stuff, one that divides his investment up into monthly amounts, one that has the worst timing ever, which is equally as like unpredictable as Mr. Perfect up the top here, and the person that doesn't do anything. And what they found was if you gave them $2,000 at the start of the year to put into the S&P 500, or for Australians, that might look something like, it's not a perfect thing because we have currency in the middle, but it might look something like IVV or IHVV. They basically said if you took this investment, you took $2,000 and you gave these five people this $2,000 on January 1st every year, and you put, $2,000 in at the perfect time of that year, the lowest possible day, that's Peter Perfect. If you did it on the first day of the year, if you divided that $2,000 up into monthly amounts, you had the worst timing, so you bought at the highest possible price that year, or you didn't do any of that and you just left your money in cash. This was the outcome. And I know some of you have seen me present this before, and there are other studies, but this one was done over 20 years, from 2005 to 2024, basically to show you the impact of just consistency. Like you can try to be the perfect person and have the perfect timing and be like, oh, I don't like what's going on in the Middle East. I'm not going to buy right now. And then the stock market goes up, right? And you're like, why did that happen? And what we can see from this chart, and the thing that's obvious is that if you have perfect timing, yeah, you're great, but no one has perfect timing. Likewise, no one has the worst timing. Like no one has the complete opposite of perfect. A lot of people do stay in cash for decades or years at least. They're just so scared and paralyzed about investing. I'd love to know from anyone in the chat, did you hold off investing for a while because you were worried about it? Like, did you hold off, for weeks, months, days, years? How long did you hold off before you invested? Some people maybe like me are a bit like, oh, this thing's interesting. Like, I think a lot of dare I say it, a lot of young men like myself were like, oh, I can make money from this thing called the stock market. Let's put some money in. Whereas some people aren't like that. Um, did not start until I turned 50, Jacqueline. Jacqueline, but my question to you would be, were you ready to start? Like, or was it just that you didn't have the ability to start? Like, could you have started earlier? I guess is probably the my follow-up question to that. But if we kind of zoom out and we actually just look at the big columns here for a second, this is the critical insight for me. And I'll come back to that. Blair said, didn't got burnt on specky stock, stayed out of the market for 10 years. That's pretty common, mate. Don't like hold that against yourself. John said, started at 60, was scared until I found Perla. That's wow, mate. That's actually like a super endorsement. Like it goes to show there's been brokerage platforms for decades, right? That's really, really great. Rose held off for 3 to 5 years. It seemed too intimidating. You're not alone. Did not start until I was 50, says Caroline. Darcy says, totally still do. Invested a little bit for a few years. About a year or so, says Maria. Kirsty says, I didn't get it when I first started learning about it at age 50. I now know better, so I do better. Just start. Yeah, great. Karen says, I'm Larry because I didn't know anything about it. Once I learned the basics, I jumped into ETFs, but not sure what's next for the bigger picture plan, late 40s. That's cool. You got plenty of time, Karen. That's great. Eswara, you said no, just kept on investing once I started. Amazing. Okay. I'm going to read a few more of these because they're actually like really powerful statements. So thank you. Um, Back to this chart. The thing that's really powerful for me, why don't I just take a screenshot from the Schwab website? I'm sure they'll love me just ripping this off. So I'll just do that. Where am I? Nope, this one. All right, let's grab that and drop it in here. Shout out to Canva. Canva's awesome. Sydney-based startup that I'm sure loves paying more tax on their stock. So let's have a look at this. The thing that really gets me about this chart, right, is I think most of us are like Matthew here. Most of us are Matthew monthlies. We just take whatever we got and we put it in the stock market. It's pretty simple. But what is really fascinating about this is if we take our little Mr. Squiggle, the thing that always blows me away is how similar these two are relative to this line here, right? So I'm not a chartist, but if I was, this would be the extent of it. So chartist is like a person in finance that makes predictions based on stock price charts. It's kind of like the Reiki of the stock market. No, and that's probably throwing shade at Reiki healers, but realistically, it's not real science. So here we can see that the actual distance between these two things is not that far apart, right? But the distance between this and this is a long way. So we'll put a little exclamation mark here. What's really interesting about this, right, is none of us can ever have perfect timing. None of us will ever have the absolute worst timing, although it can feel like it. Someone said this before. Most of us could just take our $2,000 a year and put it in the market on January 1st. Easy. Most of us could take whatever amount of money we have and invest it each month. Easy. Also easy is staying in cash. But as we know, that's diabolical. I'll come back to that. These, in terms of how hard they are, thanks to ETFs and automation, are so easy to do. And the crazy thing is, like, where else in your life can you do the easiest possible thing and probably get a 90% or better score? That's the reality. You can, like, if there was a thing in your life that was so powerful for you to do, that was so easy and easier than this, I would be like gobsmacked. You can literally just find simple investments like ETFs, automate it, invest regularly, and forget about it, and you'll probably be in the top 10%, the top decile. Now let's talk a little bit about Larry down here. Warren Buffett has a famous quote that's often lost on people. He says that in the short term, stocks are risky. We know that. But in the long term, stocks are risky not to own. And what he meant by that was over the long term, like this is obviously a very good stock chart, but over the long term, it looks like this. In the short term, it looks like this, or as we saw in the case of VAS before, 10 years, very good. 1 year, not very good. 1 month, also not very good. But the longer you go on, the longer that line starts to smooth out, and the longer you get, the easier it is to get closer to these results. So this has worked over the past year because people who had invested, where is this? People who had invested at the top, obviously, if they invested everything, that would be rosy rotten. At the bottom would be Peter perfect. But had you just invested consistently over the years, you would have averaged out these returns. And over 10 years, you would have averaged out these returns. So my big lesson for this year is just try to tune out the noise and try to be focused on just controlling what you can control. If we go back to just the final lesson here, is that optimism wins. I was trying to find a chart before we jumped on air. Um, So optimism in the stock market is all that really matters. And let me explain why. I don't actually have the. I was going to show you a different chart, but I'll just make. I don't really like this one. Let me just see if I've got one. Um, where is it? I think it's called multiple. And feel free to get your questions in, guys. I'm going to start getting to the stocks in a sec. Multiply, I think it's called S&P 500 earnings per share. This one. So what this chart shows is the growth of profits since 1871 to the 2000 through to 2026. It shows the profit growth of companies in the United States. So what this is showing you is not the share prices, it's actually showing you how much profit they made. Like if you added up all the companies and then you got the profits, how much over time. And as you can see, the reason the stock market goes up is because companies produce more profit. And they produce more profit because they solve more problems. And the more you think about it, share prices are going up. They're being driven by the profitability of the companies. What are companies? Companies are just people that come together and solve a problem for a customer. Those people find new problems and new companies exist, and then we solve those problems. And that's why this happens. There's no mystery about why the stock market goes up. It's because people, if you tie it far enough back, people are just solving more and more problems. And they're solving bigger and bigger problems, like artificial intelligence versus inventing the steam engine. Steam engine was very powerful, but artificial intelligence is way more tricky in the modern era, relies on all the other technology that got built, like steam engines, like way back when, that then become, cloud computing and putting data centers in space, building reusable rockets. So this is why the stock market goes up. And if you think about it long enough, what you ultimately conclude, I think, is that optimism wins. Even in the short term, things might sound negative. They might seem like it's good to avoid the stock market or it's good to avoid things. But the longer you go, the more you realize that optimism wins. Now, I do want to get into some stocks, but I really want to read a couple more of these ever so quickly. So let me just read a couple of these real quick. We can see here, doop-be-doop-be-doo. Okay, no. Oh, here we go. Lisa says, oh, sorry, Liza, you say, been micro investing since I was 19 and have started slowly increasing the weekly amount. That is huge. I don't know how old you are, but I assume that that's amazing. Pip says, I didn't even know stocks were I think real people did. I thought it was only the Wolf of Wall Street. That's probably because all of Wall Street, all of Hollywood makes you think people that invest are evil or people that have money are bad. It's always the billionaire, right? That's the plot of every movie that I don't want to be the spoiler, but any movie involving bad people, find the one that has the money, they'll make that person look bad. That's pretty much the gist. Kirsty says, I followed Mal Brown and did her course. That's amazing. Catherine says, Sartek in 1986, still there. Cool. Cool. Oh, you couldn't share my screen. Could you not share see my screen? Okay. Let me just quickly recap. I thought I could see this, guys. I'm so sorry. This was the screen that I was sharing before. Could you not see this? That's really disappointing. I thought we were all on the same page. Oh, we could see the screen. Okay. Okay. Cool. So it was good. Phew. I was like, oh no. Okay, Eswara, you said you followed Rask. That's great. That's great. Cool. Now, I want to get into some things. XMet says Faith. Now, I'm going to bring in some stocks and some ETFs here. I will make a disclosure that I do own two of them. I own two of the stocks, one of the ETFs. I sold one of the stocks and looked like an idiot, but that's okay. I'll cover that when I get to it. Can you guys please tell me if you were to pick one of the stocks, or one stock or one ETF that you like for the next 12 months, even if you don't own it? Tell me what it is, and let's talk about that for a minute as well. But I'm going to crack on with one, and why don't we start with judo, seeing that that's where we began the day, so we can see that here. Cool. So judo, what does it do? Judo is a bank that specializes in lending money to small businesses. I think it was Mukesh at the beginning of the show said that the reason why the stock price fell 40%, and I'm keeping it on Google because it looks more severe, which is why we like Perla. But it actually fell from $1.50 down to 90 cents. Now, it's interesting because most of the time when I've come across really great investments, it's actually not been the companies that have fallen that make me a lot of money afterwards. It's the companies that have already been doing well that keep on doing well. And that's the thing that's been really interesting for me. Now, this stock fell 46% in one day, which I think that's kind of crazy to me that it fell so hard. And so we've got to ask ourselves, like, why did it fall so hard? Well, as we can see here on marketindex.com.au, we can see that the company came out and said that there were three like customers, like people that borrow money from Judo Bank that ran into trouble. And I went a bit deeper into this. I've actually got my notes over here on a separate laptop. And I was reading through the analyst call that the management team did. And basically, I was trying to think, like, why is everyone so worried about this in particular? Because the company's come out and said that they're going to have a profit of 163 to 169 million dollars, which is down from the previous expectation, right? But it's actually still up. So it's still growing. Like if you look down here, the profit of 210 to 220 million dollars, it's actually still up on where it was. It's only that the analysts expected more. So really important to understand is how banks make money. Banks make money by lending what they have to people that need it and then charging a percentage margin in between. That's called the net interest margin, which is the margin that is the difference between what they give money out for and what they get money back for. This here is one of the highest net interest margins of all the banks in Australia. And the reason it is because they lend to small businesses. I would love to know if anyone here in the chat, I can see you've all got your picks in. People are picking Rocket, VDHD, Dragon, says Arnie. Um, if you've ever come across Judo Bank, what was your experience with them? I'd love to know what you think. Like, what was your experience with Judo Bank if you have dealt with them? Real quick scuttlebutt. Now, Judo Bank actually sold off quite heavily on these three customers, but the reality is their business is actually growing very, very well. And I I don't know about you guys, but there aren't many companies in Australia where I'm like, actually, you know what? This is a business that has, it's a small to medium sized business. It's $1 billion in size, which is, it sounds like a lot of money to us, but in company world, that's kind of like small, like medium size in Australia, small to medium size. Um, and it's actually a business that's growing. It's a business that still has, as far as I'm aware, it still has the co-founder as a director. He's not involved in the business day to day anymore. It's a business that is in a genuinely important market in Australia, which is lending to small businesses. And it's a business that customers that I speak to, I've never met a customer that doesn't like dealing with Judo Bank, which is bizarre when you think about your experience with a bank. Um, So Gerda says, I had a positive experience with Judo Bank overall. I only had a term deposit with them though. Yeah, they're really big in term deposits now. Like a lot of people are using them for term deposits. Um, because if you think about it, this is a good lesson to everyone. As I said before, Judo Bank, according to this market index reporting here, which is basically right, they have a net interest margin of 3%. How do you get that 3%? Well, what happens is, I'll just get my Mr. Squiggle out again. And then forgive me, for those of you that don't know who Mr. Squiggle is, very important part of my life and many of the people that are attending today. So if you're a bank in the middle, this is my attempt at a bank, guys. So that's what my bank looks like. You wouldn't probably, it looks more like a prison, but sometimes banks feel like that. So if you're the person that's getting the money on this side, you might have to pay the bank, say, I don't know, let's say you pay the bank 10% on an interest loan for your debt, right? So this is for a business paying interest. It's not like a mortgage. In a mortgage, it might be like 6% or 6.5%. But if on the other side, we have a investor who's got money, or like a saver. So this is the person that wants to get a good term deposit rate. Because Judo Bank is making the 10% over here and not 6% like you'd get from a mortgage, they can actually offer this person a better term deposit rate, right? Because 10%, if you're Judo Bank lending, we'll just do a big J there so we know what that is. 10%, like even if they kept their 3%, right? Their 3% profit margin, that means that they could offer you 7%, right? So it's not, this is a simplified version, but it gives you an idea of why their term deposits are growing really fast. It's because people that want to lend and get a good term deposit rate can look at Judo Bank and be like, oh, that's like as good or maybe better sometimes than CBA or Macquarie or whatever. That's because on the other side, their business is doing really well here. The problem is three of their customers overall had really suffered recently. And basically, what happens when a bank lends money, they assume that a certain percentage of this number, like the number of customers and the percentage overall that they receive, will default. So in banking, we call that a collective provision. So they have this kind of thing where they go, based on the last few years, we expect 2% of customers to fall behind by 30 days or something, right? And then they express that as a number. But they also have to incur once off or individual loan failures. So say, for example, with Commonwealth Bank, they have like millions of people that have a loan with them. So one failing is not that big of a deal. But when you're Judo Bank and you're a smaller bank and you do bigger loans for businesses, if one or two of the bigger ones fail, that actually does have a noticeable impact on your profit. But for the most part, I actually think this business is really interesting. I didn't expect to talk about it today. It's only that I saw it late last night that it had fallen. And I was like, this is a really interesting company that people should have on their watch list. It's a bit more on the riskier end, but it's a really interesting one. So one to add to the watch list, and hopefully that education on banks wasn't too boring for you. But I think it's a good lesson and helps you understand how everything works. All right, so that's Judo on my list. I don't own this, by the way. I'll tell you if I own something on the way through. The next company that I wanted to bring to y'all's attention is none other than Berkshire Hathaway. Does anyone know what this company does? Does anyone want to guess what this company does? Um, Maria, you've asked, is Judo VSO? No, so Judo is JDO. This is an individual stock. Um, so um, it's not like an ETF, Maria. So Maria, an ETF is like a basket of individual shares. So you might get like hundreds of shares in one basket. Judo is one of the individual shares that might be in that basket. So by that extent, it's actually riskier. Um, so just quick bit of education, just to make sure we're on the same page with this, because it is important to me that I don't leave any risk on the table for you guys and you understand how it works. So when you have an ETF, people often express it like they express it like a basket, like I just did, which works until it doesn't work. So if you think about it, if you're investing at this point in time, normally what you see when you own individual stocks is you'll see a share price chart that looks maybe something like this and, it goes up and down like this, right? So that might be a stock, right? But then what happens is if you own a bad stock, just that same starting point, actually I'll choose a better color because no one can see that. We'll go just white. So if you own a different stock, you might find that, oh, look, it's okay. Oh, yeah, it's had a good bit. Yep, cool. And then all of a sudden it falls, right? And your stock ends up down here. Then if you go again, and then this time you have another stock, and this one is a really good stock. So you own a really positive stock like Macquarie at the moment or Commonwealth Bank, and it just keeps going up, and you're like, wow. Now, what actually happens with ETF investors? So when an ETF owns a bunch of stocks, right? There's two insights here that you kind of need to get your head around. Jake, you said, are there any ETFs that would contain judo? I'd imagine that VAS, Vanguard, would contain judo. So this is actually a good time. So we've got one stock that's doing really well, one stock that did okay, and one stock that did really bad. The actual math, if you do it over the entire stock market, it's like most do not very good. One or two out of 100 does very good, and that's what outweighs all the losers. But what effectively happens, right? When you have an ETF, and say your ETF has like 300 shares in it, like VAS, which I said before. So VAS, which is this one. It's got 300 shares inside it. I don't think we can check this far down, but I'd imagine if someone wants to go and check it on the Vanguard website, they'll be able to see that it probably has a very, very, very small holding in Judo Bank. Remember, guys, I wanted to talk a bit more about stocks in this one because the last live we did had more ETFs. So if you took this basket of investments, what effectively happens if you had 1/3 of your money in this one, 1/3 of your money in this one, and 1/3 of your money in this one? If you've done statistics 201 at university, or even maybe the statistics 101, if you took that, basically what would happen if your whole portfolio was 1/3, 1/3, 1/3, is it would probably look something maybe a bit more skewed than that. Maybe it would look something like that, or maybe just slightly below. So if you had 1/3 in each, you would have some losers, some okay, and one winner. And that's the general trajectory of your portfolio. Imagine, for example, that this white line is Judo Bank, and that one's CBA, and this one's Macquarie, like different banks, but whatever. Some have done well, some haven't done well. When you own an ETF, effectively what happens is this. I'm going to show you, and it all makes sense. All right. Effectively, when you have a diversified portfolio, you can never do better than your best stock and never do worse than your worst stock. Sounds simple, right? It's a bit of a tongue twister. But ultimately what happens is you are narrowing the range of outcomes. So if you have enough shares and ETFs in your portfolio, the range of outcomes that you get is much narrower. And I'm going to explain what this means. I'm not talking like a professor that just makes no sense. But if you took an actual color, Owen, let's go with the blue one. If you were an individual stock investor and you had just 3 shares, your outcome, if you'd weighted it differently, could be anything from up there to down there, or an individual stock investor, I should say, could have anything from this one down to this one. Like you could buy a stock, I could buy a stock, someone else could buy a stock. And at the end of the year, we all swap notes. One of us has crushed it. One of us did okay. And one of us was like a dead set loser. But if we all own the same collection of shares via an ETF, the range of outcomes would probably be somewhere in here. Now, I hope this makes sense. And I really wanted to cover this for Maria's sake and for anyone that doesn't understand how an ETF reduces the risk in your portfolio, because it is really, really simple to understand this idea of like why ETF investors are never like the world's best investor, but they're also not the world's worst investor. So I hope that makes sense. So Roger, you say, is your example of averaging these 3 shares equivalent to an unweighted ETF? It's equivalent to an equally weighted ETF, Roger. One thing that happens, this is the final thing I'll say. because I don't want to make the whole session about like portfolio theory. I'm happy to do that in any of the upcoming webinars, by the way, but for today's sake, I want to get to the companies. Um, what happens in an ETF like VAS, which I keep coming up because it's the most popular on Perla, um, is that over time, what happens is if we take a bit more of a time period rather than just 1 year, this share might actually keep growing right up the top here. And in the beginning, they're all 33% each, right? They're all 33% each. But by the midway point, like here, they're probably like 40, 30, 30. And by the end of the year, it might be like this particular holding is like 50%. This one's like 30%. And this one's like 20%. That's how you end up with an ETF that looks like Vanguard VAS, right? And there we go, this one. That's how you end up with an ETF that has more of its holdings in the bigger companies and less of its holdings in the smaller companies, all right? That's how they work. And if you think about it, you want it to work like that because, like I said earlier, the companies that do really well tend to keep doing really well. It's just like a thing that happens. BHP tends to keep doing really well. But then when it stops doing really well, what happens is something else takes its place and it takes the big position. And that's how it works. So I'm happy to dive into that in the future or even in a blog post for Perla, whatever you guys want. Now, Anton, how many ETFs should one hold, generally speaking, to have a decent return? Well, it's the answer is it depends. And I have to speak generally, but what I generally see with our community and with the Perla community as well, not many people have one ETF. Some do, like a VDHG or a DHHF or something. A lot of people tend to have like a handful. If you started to have like 20 ETFs, I'd probably say like make sure you write down on a piece of paper like why each one does each thing. And if you have a coherent answer for that, then cool. But if you don't, whatever. Now, see, Blair, you've just said that GARP is my only ETF. See, GARP's a great ETF. But you might have only GARP, but then a bunch of other stocks or a property or some share, cash or a business or other things going on in your life. Like, yeah, you might have only one ETF, but you might have other stuff, right? And that's the essence of diversification as well. Raj, you said, question, post-budget, no capital gains tax discount now. What's now the recommended tax-efficient structure to buy an income-producing ETF like VHY? Is that intended to be sold off in a decade to fund retirement or kids' expenses? Yeah, so thanks for following up, by the way, Blair, as well, with your 20 stock portfolio. See, that's pretty common. What we tend to see is that more experienced investors, like not always a good thing, but more experienced investors tend to be comfortable holding some shares alongside the ETFs. Whereas a lot of people that are starting out just want ETFs, which is totally fine. AV, 8 ETFs, 3 income ETFs, 5 growth. Cool. Nice. I like it. So, Raj, back to your question. VHY versus VAS. I think based on the government's changes with tax, I think more people are going to opt for income producing investments. So I don't think that that's necessarily a good thing because I think Australia needs more people to go out and invest in growth stuff so that the founders and the business owners get support. But realistically, why would you do that? If you're an investor, why would you support someone to do this really innovative thing and be really creative if you're going to be unfairly taxed for that versus just buying a bank, like a bank share, like CBA? Like, why would you do that? Doesn't make sense. So most people, I'd imagine, especially, well, really anyone that's got a job that pays tax would probably be opting for, maybe not everyone that has a job, but like there'll be a lot of people that opt for income. Okay, so Russell, what's the difference between Berkshire A and B? I'm going to try and zoom through these last companies. I didn't realize it's been so long on this thing. Berkshire Hathaway is Warren Buffett's company. There are two different stocks, Berkshire A and Berkshire B. Berkshire B is for us here, most of us, unless some of us have Berkshire A and we have the big dollar a do's. I'll just go like BRK. So Berkshire, what's the difference between that one and this one that's $733,000, 399 and 99 cents a share USD, which is by my calculations about infinity Australian dollars. The simple answer is that when Berkshire set out on its mission, it kind of didn't want to do any dividends and it didn't want to do any um, what we call stock splits. That's where the stock splits into smaller stocks. So if you had one stock before and they did a 10 for one, you'd have 10 stocks afterwards. Still the same amount of investment, just different shares. Um, well, Warren Buffett, what they found was that when they had this really high share price like they do now, a lot of investors couldn't afford to buy a whole share. Like nowadays, no one can really, who can afford a $733,000 share price? So what they did was they realized that, oh, hold on a second, not everyone can afford this. And there are a bunch of investment banks out there that are promising people some Berkshire shares. And what they would do is the investment banks would go like, we'll buy the share for $700,000 and you guys give us money and we'll just say that you own some of what we have. It's kind of like making their own little mini market where you can't afford it. Let's all pile together and I'll manage it for you and you get some Berkshire shares. And what Berkshire was like said was like, well, let's just invent this new class, Berkshire B, and just make it so it's a smaller percentage ownership, but the share price is smaller so people can buy. That's effectively what's happened. Now, I'm going to be real quick. Warren Buffett is the guy who didn't found this company. Originally, I think it was Anton or someone in the chat said that originally Berkshire was a textiles factory. They'd make every type of textile that you could think of. And then obviously the United States got competed out by that. And a lot of that stuff is now in China and India and places like this. And instead, they took the company and then turned it into an investment company. So the company went from textiles and selling stuff out of a factory to actually just taking what money they had and then buying other businesses. They bought See's Candy, they bought a bunch of like an insurer, and they bought a bunch of these other companies. Now, what makes this really, really, really interesting is Berkshire is not an ETF. It's not, it's like an individual company, kind of like judo, except it's a company of like many companies inside. And what we've figured out over time is that it kind of has some unfair advantages. It's what we call a conglomerate, but it's actually a good one. In effect, what has happened is Warren Buffett was able to take this company, which is kind of like an insurer, kind of like a railroad, kind of like a solar farm company, kind of like a chocolate company, and take all of these great companies, make sure they're profitable, and then every time they made a profit in those individual businesses, send the money back to headquarters and then buy more companies. And now it's got to this size where it just keeps growing and growing and growing. And there are a lot of things about it that's actually really, really interesting. Alan Paul and Rask. I recently did an interview. For folks that are interested, you can go and Google this in your own time. But I did this discussion with this guy called Alan Pullen from Magellan Financial Group. He's an Australian fund manager, and they are a big investor in Berkshire Hathaway. And he breaks it down one by one by one, the individual reasons why Berkshire has been so successful when all the other companies have basically failed. So it's a really interesting discussion. It's a good one for the watch list. And a really, really interesting business to pop on your watch list. Now I'm going to keep moving. Mukesh, was Charlie Munger part of this? Charlie Munger was indeed part of this. Charlie had his own partnership before Berkshire called Munger Partnership. I think it was Charlie Munger's partnership. And then he closed that down and just put all of his shares and money into Berkshire and worked with Warren instead. Charlie Munger is arguably like, well, Warren's got the track record, but Charlie's arguably the more insightful of the two. He's now passed away. So let's go from that to another company. If you're not a company, let's go to an ETF. So IVV is one of the most popular ETFs on Pearler. It's also one of the most popular ETFs in all of Australia. It takes your money, bundles it up, and then sends it over to US companies, and you get 500 US companies in one. Now, I did have a bit of a chart here that I wanted to show you. This one. I'm just going to grab this. This relates to my point from earlier. I'm going to be real quick. This is an educational lesson. I wasn't sure if I was going to include it, hence why I put it down the back. Just get rid of all that stuff and just drop it here. Okay, so what this chart shows you is why ETFs go up, and it ties in with that other thing that I showed you earlier on. So when you have an ETF, inside the ETF are companies or bonds or whatever it is that's inside of it. Let's say it's companies. Before I showed you the growth of the American stock market through time. So this is the profit growth of all the companies. If you just set it at whatever it was at the time, $10.67 in 1871, and then you calculated it every year all the way up until today, this is how much profit would be inside those companies. The easiest way that Australians get access to this is through the IVV ETF. This is the S&P 500. So you take your money in Australia on Perla, you click buy on here, like you click buy here, you're effectively putting your money into 500 companies in the United States in a roundabout way. There are other ETFs that allow you to do this. You can see NDQ from BetaShares and you can see FANG from GlobalX. I asked the GlobalX team to do some maths for me because one of the ETFs, this is the second ETF that I wanted to bring to you today. I'm just going to tick that off my list. There's that one and there's this one. So if IVV has 500 companies inside it, so it's really well diversified, this is a ETF that isn't as well diversified. It has 10 companies. 10 for FANG, that's this one, FANG, versus 500 for IVV. Now, most people who believe, quote unquote, believe in ETFs, because you don't have to believe in them, they just are what they are. Most people who believe in ETFs think that you need to be really diversified. That's why everyone loves VGS. I don't really like the VGS ETF because I think it's too diversified, but some people love it. So that's fine for them. What this chart illustrates here, and I asked the GlobalX team to help me out a bit with this one, is it shows you if you took 100 cents or $1 and you had them invested in the 10 companies in FANG, the 500 in IVV, or the 100 in NDQ, that's the other ETF, what is the profit of those companies through time, right? So starting in 2018, which is when the FANG ETF came into existence, it's the newest one, they said down here, they're like, okay, everyone, we've got 100 cents. Let's rebase it at 100. What have the companies inside of those ETFs done in terms of growing their profits? And so you can see up here that it's basically $10, 10 for one in the FANG ETF. So the companies that are inside FANG have now got 10 times more profitable. The companies that are inside the IVV index, and it's about $2 or something. The companies that are inside the NDQ ETF are $2.50, or say $2.60. I don't know what the exact figure is off the top of my head. But you can see over time, those companies have grown their profits. Therefore, it's no surprise that over time, the share prices have gone up, right? So this is, everyone's now connecting the dots. So you can see the share price of FANG. This is the ETF with 10 holdings. And you can see the earnings of FANG, the profits have gone up. Now, there's a good question in here. AV said, if the AI bubble bursts and we see a huge crash, how many of you would start selling versus holding on and buying more? Tell us what you think, guys. Would you buy, hold, or sell if the United States stock market fell 20%? Final comment on this. The reason why this share or this ETF has performed so well is because it is cashing in on the AI revolution. The companies inside FANG are like NVIDIA, Micron, Google, Apple, Microsoft's in there, I believe, Amazon, all of these companies are inside that ETF. Speaking of, my next company to put on our watch list, ladies and gentlemen, is Google. I'm going to be quick with this. It's more of a tech thing than a finance thing. But Google, in my opinion, is the only company in the world that currently has all of the components available to be the ultimate AI stock. I'm not saying go and buy it. I'm not being hypey. It just is what it is. This company, Google or Alphabet, which is the parent company, I'm just going to switch to the other Google. So this is also a company that has different share classes like Berkshire did before. This company has performed so well over the last little while. I'm just going to go back a bit like this. Because it's effectively gone from we do Google search to we offer Android to we have YouTube to we can now do shorts inside YouTube. We now do Google Workspace, we do Gmail, we do Google Drive, we do games, we do cloud computing through GCP, and hey, now we do AI. And this is one of those generational companies that has constantly innovated. And even though Google search should have died like 3 years ago when ChatGPT came out, it didn't. It kept on growing and it made its own AI tools, and now they're probably more amazing. So um, that's just like a business that I think, yeah, it's gone up a lot. But if you believed in the AI story, I think this is one of those businesses that wins. They make their own chips, the Tensor chips. They have their own audience, like billions and billions and billions of people that they can sell to, hundreds of millions of businesses. Um, they do their own cloud computing through GCP, and their own hyperscaling. They do their own data centers as a result of that. They offer their own software. They have built Google DeepMind and their own chatbots. So that's why I think this one is a company that deserves to be on your watch list. Now, I'm not saying that goes up into infinity, but it's one to keep an eye on. The next ETF is FANG. So FANG. Oh no, so not FANG. I've done FANG. Hack. One of my three favorite ticker symbols in Australia. These are the symbols for the companies. Hack for cybersecurity, FANG for the FANG ETF, and finally is ACDC. I just love the ACDC ticker symbol. Let me know what you think. So Hack is an ETF that invests in cybersecurity companies. There was a big thing recently where Claude or Anthropic, which is the company that creates the Claude chatbot and LLM, came out and said we're going to launch this thing called Mythos. The government has since restricted it, and basically people were spooked out and they thought that this is the most advanced cybersecurity tool ever created, which it probably is. Every other stock is not valuable anymore. And he said you invested in both Hack and ACDC, and I assume entirely because of the choice of ticker symbol. Just kidding. So this is an ETF that invests in global companies, and what's important about it is that it kind of evolves with the trends of the time. So, like for example, if we zoom in to the latest holdings, we can see these companies in here, but over time they'll cycle through because it's kind of like an index fund, but for the sector. So a really, really interesting business. Interesting ETF. With this in particular, though, I consider this to be more of a satellite holding than a core holding. So it's kind of like you got your core portfolio, which is boring, low cost, etc. And then this one might be one off to the side. It's a really interesting one. Final ETF for today. I'm just going to mark that off my list. My final ETF for today, for everyone to just learn a bit about, is not that interesting, but it is kind of interesting, which is the IXJ ETF. Does anyone own this ETF? Anyone at all? IXJ is an ETF that does global healthcare. It invests, so Evelyn owns it. It invests in a wide range of global healthcare companies. This is an ETF that, to be honest with you, I don't think has performed as well as it should have over the past 5 years. But the actual ETF itself and what it provides exposure to, which is aging population, better healthcare techniques, more expensive healthcare techniques. This is an ETF that gives you exposure to that in one basket. I think it's actually a really good ETF. It's one of the first I ever bought. I actually bought it for my mum back in the day. I bought this one and the other one, which was IXI. IXI is a ticker symbol. That one's the one that does like consumer staples. So I was kind of like, have junk food and go to the supermarket on this side. And on this side, let's be healthy. So that was kind of the one. Does IXJ include CSL, Pro Medicus, etc.? I don't believe it does. It might include CSL, but it would be a very small holding. If you wanted an ETF with Australian exposure like that, obviously all the big names, but one that we own is ATEC, ATEC. It's been pretty volatile, which brings me to my last three companies. WiseTech, Pro Medicus, and Xero. Okay, WiseTech, Pro Medicus, and Xero. Here we go. So WiseTech, where you at? WiseTech has actually put a hole in my pocket because I thought it was going to recover from a few things and it didn't. And this happened. WiseTech is a technology company that invests in that builds software that helps when you send and receive parcels across the world, think of like logistics and that sort of stuff. It helps navigate the global marketplace. Um, the thing that's really hurt it is there's been a few management issues for the business over the last few years. Like the founder came and went and came back again. It's been really controversial, like really controversial. Um, and I held it on the way down. So if anyone else has held it, let's grab a beer after this and we'll share our miseries. I'll come back to it in a second though. Pro Medicus is one of the companies that I've held since 2017. Um, Pro Medicus has also had a similar type of sell-off, but not for the same reasons at all. The reasons that, well, there's one reason that's a similar. Everyone is thinking that AI is going to completely obliterate software companies, but they miss some of the really important things. Most software companies, just as a general gist for everyone, I have a very strong belief that most software companies aren't good because they write software. They're good because the software solves the problem that the client was that the client had. So in the case of WiseTech, a company needs to send a parcel from Australia to the United Kingdom. It has to go on a boat or it has to go by air, it has to go through a port, it has to go through customs, has to be tracked, has to be costed, all of these things. Um, all of these things happen in the background, right? The software, no one even thinks about the software. What they think about is the platform. And that's why that's its revenue stream. Same with Pro Medicus. Pro Medicus does software to help radiologists and people in the ED do like instant imaging. So you go in and you get a CT scan or an MRI, and in 4 seconds, you can have that file sent to a doctor around the other side of the world who's analyzing it, and then it comes back. And 4 seconds is legitimately how long it takes. And no one stops and goes, really good software here. They think this is a really good product that helps save a life. And that software needs to be installed in a hospital that can't afford to slow down. So I think that's a really common misconception that people are going through. And the final company, which has also fallen, another tech company, is Zero. So I know I talk about these quite a bit, but they're actually very cheap for a change. I'll come back. Um, So Zero, final company that I'll cover for today, is the accounting software company. Literally everyone that I've spoken to in the investment industry, like the quote unquote professionals, have gone like, well, Zero is going to be replicated by Claude, which it integrates with Claude, so maybe. It's going to be replicated by dot dot dot. It's at disruption from dot dot dot. I'm like, well, then why did 530,000 new customers use Zero in the last year? They got 530,000 new customers, not existing customers, new ones. And that's adjusting for the ones that had already left. So it's kind of like, are we all still reading the same report here? Yes, it was overvalued. Yes, the management team may be a bit of a dog's breakfast in some respects, but ultimately, this is a really good business and a really good platform. Most of us that are business owners don't have time to take our financial statements as a business, go and put it into ChatGPT and be like, did I make a profit? Tell me how much super I need to pay. Can you file my taxes for me while you're here? And also make sure that my superannuation is recorded with the ATO. That's not how it works. Like Zero does all that for you, and you don't want hallucination in any of that work that you've got to do. So I actually think that people are underestimating Zero. I wrote about this on the weekend, but Peter Lynch has this famous quote that you should buy a company that even a monkey could run, because eventually one will. I'm not saying, I'm not like implying anything, but what I'm saying is like, if you have to choose between a really good company and like an average CEO, she's actually pretty good, Sukhinder from Zero for what it's worth. Um, uh, yeah, she's actually pretty good. So if you have to choose between a really good company and a really good CEO, go with the company. This is like if you choose to bet on the Melbourne Cup, find the good horse, then find the good jockey. Don't find the good jockey and put him on a donkey, because that's not going to work. Find the really good horse, far lap, then put the jockey on top of that, not the other way around. And I think if you do that as an investor, you're more likely to have success. So I just want to recap before I just say good day to everyone. The companies for today are WiseTech, Pro Medicus, Zero. I own Pro Medicus and WiseTech, FYI. Berkshire Hathaway from the United States, Judo Bank, Google, which is AI and cloud computing, IVV, Fang, Hack, IXJ. That's my list of stocks. What do we think, ladies and gents? We've got some questions in here. Do, 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 do. Do, 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 do. Good questions, good questions, good questions. Do, 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 do. Okay, so I can see a long one from Nick in here. Well, if anyone has any quick questions for the end, let's get them in. We're back in a couple of weeks, so stay tuned to the Perla email, the Rask email. We'll be back here. Do, 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 do. Oh, okay. So Nick, you've said you purchased a number of books that we have mentioned, and put in place a number of small strategy and have a positive response. Each week, I look forward to listening to the RAS podcast, finance, retirement, investors, property. Thank you, mate. I really enjoy the presenters you have. They are great. I like the analysis of the 5 different personas, knowing that just doing something is so much more valuable. Thank you. Thank you, mate. It's obviously Charles Schwab that did a lot of that work. Like everybody, I wish I started sooner. However, I look forward to the consistency building progress into the future. It's all about consistency. It's getting the reps in. So much of the time, realistically, most people delay investing because of like the fear of choosing the wrong thing, not knowing enough, not having enough money, these types of things. If you just rocked up to these webinars once a month, or you just go into the Pearl platform, there's so much education there. Like it won't take long to get really confident in what's happening. And from today's session, if you look at, just go back and replay on the Pearl YouTube channel, that section where I talked about why the stock market goes up, those first 3 lessons. If everyone in Australia just knew that, every single person in Australia would be an investor. It's just, there's all these other smoke and mirrors out here about you need to be able to put things on a chart or watch some guy on the telly tell you something. Like, it doesn't make sense. Okay, so list, I'm going to put Gerda for you. Above you, I'm going to put this in the chat now. So I'm going to put in the list of things. If you're on YouTube, I'll read them out as I pop them in. So these are not recommendations to go and buy them. I want to be very clear about that. They're just things that you might want to put on your watch list and do some further research. I'm just going to pop them all in here. Oh, I could do emoji there. That's a weird emoji. Okay, sorry, Pro Medicus was turning into emoji for me. WiseTech, Pro Medicus. What else we got here? Xero. All of those 3 shares, by the way, WiseTech, Pro Medicus, Xero, are available in the BetaShares ATEC ETF, ATEC. Hathaway, which is MYSC, BRKB. We've got Judo Bank, which is probably the most risky, I would say, or one of the more risky of the things that I've talked about today. They're all, everything comes with risk, right? So Alphabet, which is on the ticker symbol GOOG. There was a question about that just a minute ago. The IVV ETF, it's the S&P 500. I'm writing these in as I'm doing this, so you better copy paste, guys. That again, it's not about going and buying them all. It's just about knowing what they do. Global X FANG ETF, FANG, BetaShares Cyber ETF, HACK, and then the iShares Global Health, IXJ. So that's all in the chat now. So Sarah, this is available on replay anytime you like on the Perla website, and I'm still sharing my screen here. I'm also going to remind everyone that if you go to perla.com/rask, I'll pop this back in the chat now, y'all. You can get those free trades over the next little while. So just a reminder of this, if you're an existing customer of Perla, from tomorrow, if you use that link, RAS doesn't make anything from you using that, just so you know. You'll get 1 free trade for 12 months on the new thing that you use. So for example, if you have an Australian shares account inside Perla, and then you wanted to open up the US shares account side of it, which isn't hard, you may as well do it, then that's where the benefit applies. Or if you're a new customer, you get it for joining the platform. I hope that makes sense. T's and C's on the website, of course. I'm just a guy with a hat on. Sarah, yeah, it's all available on replays. And the 3 things to remember were these. Know what you can control when you're investing or managing your money. Remember that there's a circle. There's like things that are outside of your control, things that you can influence, and things you can control. What you can control is how much you save, how often you invest, what you invest in, when you decide to sell. Things that you might be able to influence are how much you get paid, the choice of job, and there's career prospects, who you get into relationship with, and how they manage their money. Things you can't control, what happens with tax policy, what happens in the economy, what happens with interest rates, what happens in the Middle East, Donald Trump tweeting things. You can't control any of those. You can't even influence them. So don't even try to think about them too much. Just know what they are and play to the rules of the game. The other thing that I said was dollar cost averaging wins. Little bits, lots of times. It's not about having a lot of money to start. It's about doing it consistently. And the final thing was optimism. Optimism works in the share market because people solve more problems over time, not less. Optimism works in the share market because if it didn't, don't invest. Just go and buy some baked beans, grab your shotgun shells and head to the hills. Because that's like, if you're a pessimist, that would be a better outcome for you, probably. I'm not saying to do that, but that's probably what you'd be better off doing. But if you're an optimist, effectively what you are doing is you are taking money from your bank account that you could spend on a soy latte, and you're saying, I'm going to put this somewhere where it benefits me in the future. And the reason I'm going to do that is because the future will be better than today. I will have more money to spend on things that I want to do in the future. So I will put that money there now rather than use it. And so if you think about that, every single person that's on this webinar is an optimist, because otherwise you wouldn't be here learning about the share market. And anytime someone throws negativity at you, just remember that. That's how it works. Okay, guys. So I'll see you in a couple of weeks. We are going to cover where I would put my tax return. Now, if you're anything like me, I've got the double fingers like the cowboy pistols here, but I am like not getting a tax return this year. I'll give you the tip. I'm going to be paying a lot of tax. And as you start to invest, you will realize that you pay more tax than you get back. But that's a good thing. If you are getting a tax return though, next time we're going to cover what you can invest in, and we're going to bring some ideas to the table. And hopefully we will have some guests on the show in the next couple of weeks and months. So don't forget to subscribe to the Pearl YouTube channel. We're on Zoom right now, but you can head over to the Pearl YouTube channel. My name's Owen Rask. Thanks for joining me. Don't forget, any of the information that you heard in today's show is strictly general in nature. We don't know your needs, goals, or objectives. So be sure to refer to a financial planner before you act on it, and read the PDS and TMD of any ETF that I mentioned today. You'll find more details about the Pearler platform as well as T's and C's on pearler.com. Thanks, everyone. Have a wonderful rest of your week. Happy end of financial year. I'll see you in the new year. Bye for now.